Alright, so let's talk about IPOs in this video because ever so often students would ask in the chat groups on email, Adam, what do you think about this IPO? I'm thinking of buying this IPO, and they tend to get really excited about IPOs. Last year it was Uber, it was Lyft, it was Beyond Meat, right? This year it's kind of like Snowflake, and Robinhood is gonna get the IPO really soon. So why the fascination of IPOs? Why are people so interested in them? For the uninitiated, IPO stands for Initial Public Offering. It's when a stock gets listed on the stock exchange for the very first time. It's a virgin stock, okay? So basically what happens is that the company is a private company initially, and they are selling shares to the public for the first time. So think about it as you're being invited to be a shareholder in this new business. So you buy the shares, and it gets listed on the stock exchange for the first time. So once again, why are many investors intrigued at IPOs and are interested to invest in them even though they know nothing about the business very often? Because a lot of people have the misconception that, hey, when I buy an IPO, I'm getting it at a discount. I'm buying the price while it's still cheap. I'm getting it while it's a baby before it becomes an adult, okay? It's going to be a low price and it's probably a hot deal. And I'm going to explain in this video that more often than not, IPOs are not cheap. They're actually really expensive. And IPOs do not all turn out really well, right? I mean, we all would have loved to buy Facebook when it IPO'd, Amazon when it IPO'd, Google when it IPO'd. But those are the exceptions rather than the norm. In fact, most IPOs go down the shithole, right? And they end up losing lots of money. But there are good ones around. So how do you identify the good IPOs and avoid the lousy ones? And should you invest in IPOs in the first place? So let's explore all this in this video. So before you decide to buy shares of this new company, it's really important to ask this question. Why does the company want to sell you their shares in the first place? And why do they want to invite you to become a shareholder in their business? There was initially a private business, but now they're opening up for the public to be part shareholders. Is it because they love you? Is it because they make a lot of money and want to share the love with you? I don't think so, okay? Everyone does it for their own self-interest. So remember this, when a company sells shares to the public in order to list their company, they're doing it to raise money. So why does a business want to raise money? A few reasons, right? So sometimes a company, they want to raise money to use the money to expand and to grow even faster. They want to raise the funds for expansion. And that makes a lot of sense, okay? But then there's some companies, they go IPO to raise money because they got a shitload of debt. They owe a lot of money and they want to use the new money raised by you new shareholders to pay off a lot of their debt. So when you read the prospectus of an IPO, find out how are they using the money raised. If it's to pay off debt, forget it. It's a lousy IPO. But the company has little or no debt, and all the money they raise is going to be used to expand the business, all right? To create more products, build more factories, build more cars. That makes sense because you will benefit. And sometimes when a company goes IPO and they're selling shares to the public, they're not just selling new shares. They are selling what is known as vendor shares. So check this out when you read the IPO. What are vendor shares? Vendor shares means that when you buy the shares, you're buying the shares from the founders of the company. In other words, the founders of the company, the CEO, the chairman, the private equity, that were the initial investors, employees are selling their shares to you, okay? That's not a good idea because when you buy vendor shares, the money is not going into the business. It's going into the pockets of these company founders. In other words, it's their way of cashing out of the business. They want to take their money and run, okay? So that's not a good sign because that means that these founders, they don't have much faith in the long-term viability of the business. They want to take their money from the IPO, sell it to you at a high price, and they want to run eventually. All right. So again, first thing, before you buy an IPO, read the prospectus to find out, how much of the shares they're selling are new shares? how much of them are vendor shares? If there are a lot of vendor shares, you want to avoid those IPOs. If they're new shares, again, are they using it to pay off debt, or are they using it to expand the business? So that's the first thing to look for. So if you have found an IPO which you think is really attractive, it's a great business, at what price can you buy the shares at? Well, a lot of people, they would love to buy it at the original offer price. This is the price that is sold to you by the investment bank, and that's the price that the company will get for their shares. So for example, in the case of Lyft last year, this was an IPO last year, the offer price was $72. So can everyone buy the offer price? Not really. So this offer price is usually offered to preferred clients of stockbrokers. And to be a preferred client, you have to be usually a high net worth individual. You're ready to put in $250,000, $500,000, a few $1 million to get this offer price. So usually these shares are sold as placements to institutional investors, high net worth investors. So they get to buy the shares at this offer price before the shares are even traded on the stock market. Okay, so as a high net worth investor, I get offered all the time by brokers in Singapore. They say, Mr. Khoo, we've got this IPO coming up. We'd like to sell you these shares. Would you want them? So usually when I buy, I have to buy a minimum of about $250,000, $500,000, or $1 million, right? And usually when I buy it at an offer price, it's a pretty good deal. And I usually sell them the moment they are listed on the stock market. So the moment it's listed and it opens, we call it the first day pop, because usually it will open higher than the offer price. Not all the time, most of the time. So I buy it at 72, sell it at $87, the first day pop, and I run, okay? So it's not an investment, it's basically a speculative trade, all right? And that's the only time I buy IPOs, when I can buy the offer price, sell it on the first day, and I'm out of that. Now, some people ask me, hey, isn't that a lock-in period where you can't sell in the first 2 years? Yes, but that only applies to the early investors, those that got in at maybe like $20 or $10 or $1, right? Yeah, they're locked in. But for institutional investors and high net worth investors who buy the offer price, yep, you can sell on the first day. Now, if you are a small retail investor, you've got a few $1,000s, could you ever hope to buy at the offer price? To buy the shares before they're traded on the stock market? Do you have a chance to get that? Well, very rarely. And if you do get that, you should not take the offer. Why? All right, let me tell you why. Because usually, if there are any more shares left for the small retail investors, it's because it's a crap business, a crap company, where the institutional investors are saying, we don't really want the shares, all right? Or the high net worth investors, they're given the first right of refusal. And if they're not fully taken up by these guys, their shares left behind is because they think it's a crap company, right? Like WeWork, for example, right? So when brokers offer you shares, it's not because they love you. It's because the big guys, they don't want it. And you're getting the crumbs, what's left, right? So usually when you buy those, it's going to go down, right? So just bear it in mind. So for most normal investors who don't have millions to buy, you will very rarely be able to buy at the offer price. Again, unless it's a crap company. So you can probably only buy when it lists on the stock market. All right. So we call that the opening price. The moment it opens, the first day, that's the first opportunity you get to buy that. And a lot of investors ask me, Adam, should I buy the moment it opens on the stock market? And more often than not, the answer is, it's not a good idea. It's not really a good idea. And let me explain why. Again, look at Lyft, right? So if you manage to buy the offer price, good for you. The moment it opens on the first day, 87, get out. We call that the first day pop. You get out. Don't hold it, right? Why? Because usually it would come tumbling down, which it did. You can see it open at $87, and within a year, from 87, it dropped to $56. within a year. And as of today, Lyft has dropped to $22. All right. Now, Lyft, in my opinion, is not a very good business. In fact, it's quite a lousy business. So now they don't all go down. Some of them go up. Some of them do really well. So let's look at a few more examples here, right? So this is Beyond Meat. So Beyond Meat is a business that people have a lot of hope for, although I've not invested in it for other reasons. But you can see that the offer price was $25. So those big investors who got to buy at $25, good for them, right? Because the moment the stock opened on the first day, it opened at $46. So they kind of like almost double their money, right? And if they are smart, they could have, taken profit on the first day or gotten out some shares, right? Again, we call that first day pop. Now in this case, if you had bought on that first day at 46, you would have made a lot of money as well. But again, you never know. It could have gone down, right? So it's always a speculation. Now, 12 months later, Beyond Meat was at $87, which is still way above the opening price. So this is one that, went up after the opening price. Uber, this was another dud. Okay, so Uber had a lot of hype because everyone knows Uber, everyone takes Uber. So that's a mistake. Just because it's a snazzy brand or that you've used the product doesn't make it a good business. So a lot of people got caught in Uber. Uber's offer price was $45. So those insiders, well, not really insiders, but those big institutional investors bought it at $45, hoping for a pop. When it opened on the first day, it opened at $42. Ouch! It lost $3 on the first day, right? And they should have gotten out. They should have gotten out, right? So I repeat again, if you are someone who managed to get in at the offer price and you want to make a quick profit, it usually makes sense to sell on the first day, to just get out on the first day pop, because it could go either way, right? Like Beyond Meat could have gone up, but Lyft and Uber goes down the toilet, right? So in this case, it opened at 42 and it proceeded to collapse 12 months later at $27. Right now, I think it's even lower if I'm not wrong. So before you buy an IPO, it's important to ask this question. Is it a trade or is it an investment? If it is just a short-term trade, then you have to buy at the offer price. You buy at the offer price, you sell it on the first day opening, there's a first day pop, makes sense. Most of the time, you make some money. But if you want to buy on the first day it trades, you like to buy at the opening price for a trade, to me, that's not a very good idea because it could go either way. It could go up or go down. So it's kind of like a gamble. You're taking a gamble. It's a 50-50 gamble. But if you want to buy it as an investment to hold it for a couple of years, does it make sense to buy on the first day? Well, it really depends. Remember, when you're buying shares of a stock, you're buying a business. You're buying part of a business. So you got to understand the business behind the stock. If it's a good business and the business increases in value, the shares will multiply in value. If it's a lousy business, it doesn't make money, it goes down in value, you're going to lose a lot of money. The share price is going to go all the way down like Uber and Lyft. How do you know if it's a good business that's going to increase in value? Well, those of you who have taken my investing courses and have watched my videos on YouTube know that I've got a couple of criteria to analyze a business. So to me, a good business is one with consistency, one that's able to grow its sales revenue, its net income, and cash flow from operations consistently year after year after year. The problem with an IPO is a new business is you don't have much of a track record. You don't have a 5 to 10 year track record. You've got no idea can it grow sales, profits, cash flow consistently. Most IPOs only have a 3-year track record. And most IPOs, because they're the early stage, you can only see growth in their sales revenue for usually 3 years. Usually, a lot of them are losing money. They're not making money yet. So net profit is negative and cash flow is negative as well. There are a few exceptions, like Visa was an exception. When Visa listed on the stock market, it was already growing sales, net profit and cash flow for many, many years. So Visa was the only IPO that I invested in for the long run. It was the only one over many, many years, because the rest of them did not have that track record which I need to invest in a business. Most of them don't have it. The second thing is, a good business is one where they're in an industry that is growing. There's a secular growth catalyst. Like nowadays, it's biotechnology, or it's 5G, or it's artificial intelligence, or it's e-commerce, or what, something that's growing, right? Social media, so on and so forth. You don't invest in a film company like Kodak, for example, which is a sunset industry. Next thing, a good business is one which has a sustainable competitive advantage to fend off competitors. It's got what we call an economic moat. So this allows the company to protect itself from competitors. And it means that competitors cannot easily replicate and disrupt their business model. And this is the most important thing I look at in investing in the business. And again, the trouble with an IPO is usually new companies, they don't have a strong economic moat yet, which makes them very, very risky. Again, Visa was an exception. Facebook was an exception at the time. The next thing is conservative debt, really important. So we only want to invest in businesses with a lot more cash in the bank than the debt which they owe. We want it to be conservative. So I avoid stocks with lots of debt. And most importantly is the price which they are selling the shares at. The IPO offer price, is it attractively priced? So this goes down to being able to value the business. What is the true intrinsic value of the business? Okay. Now there are many ways to value a business. Usually I use the discounted cash flow valuation method. But with IPOs, you can't really use this. Why? Because for most new companies, they are not making money yet. It's negative cash flow, negative income. So you can't really use PE ratio as well because there's no E, earnings are negative, right? You can't really use PEG ratio. So for most IPOs, like again, Snowflake or Robinhood that's coming out, the only way to value the business is by comparing the share price to the revenue per share. And we call that the price to sales ratio. Another variation is the price to sales growth ratio. So I'll be using Snowflake as an example to see if Snowflake is expensive or cheap based on price to sales ratio. We'll talk about that later on in our case study. So here's the problem with IPOs. And one reason why I rarely invest in IPOs, except for again like Visa or except for that one-day pop, is because new companies are very risky compared to mature companies that have been listed for many, many years. What are the risks? The first risk is this. IPOs usually have a short track record or no track record of consistent revenue increase, net income, and cash flow from operations. So like I mentioned, a new company usually only has 3 years of revenue increase. They have not made money yet. You've got no idea, can they ever make money? So it's a bit of a gamble. It's kind of like getting married to someone on the first date. There's no track record. You have not seen their true colors yet, right? So, and that's why I always say, before you marry someone, you should at least date them for at least 3 years. I dated my girlfriend for 8 years before we got married, because in 8 years you get to really know the person. You have got a track record of consistently increasing love and kindness and honesty, whatever it is, right? But you marry someone on the first date or after a month, good luck. Usually it won't work out. Okay, you've got no track record, you've got no idea. Second thing is this: for new companies, usually the sales and profits that they report are not really genuine, okay? I know because I've got a lot of friends who listed their company in Singapore, in Hong Kong, in Asia, and they shared a lot of stories with me. And what I learned is that, see, when a company goes IPO and they sell their shares to new investors, do you think they love you? They want to give you the best price? Of course not. They always want to sell you at the highest price they can get away with, okay? And the way they jack up the share price is by jacking up the perceived valuation of the company. So what companies tend to do before they list on the stock market is they will purposely cut expenses. The CEO will take a pay cut. They won't pay bonuses. So they artificially reduce their expenses, and this will artificially boost up the profits, if any, or boost up the sales. They'll find a way to boost up the sales. So it tends to be artificially inflated before the IPO. And once it IPOs and you buy the shares, you find that, hey, why is the profit dropping even more? Why is the sales dropping? All right, because it's not sustainable. It's kind of like, when you meet someone at the nightclub or at a disco and you think they're very beautiful, it's not their real face. Okay, it's full of makeup, it's full of wonder bras or whatever it is, right? Or wonder crotch. Okay, so the next morning you wake up, is that your face? Okay, so never commit to someone, never, marry someone until you see them in broad daylight without makeup. Then it's a real person. Okay, so same thing for IPOs. And that's why I like the company to be listed for a few years and the makeup comes off, you see the real profits, the real sales, then you know, is it really a good business? Is it really attractively priced? And like I mentioned, most of the time, I would say 99.9% of the time, IPOs are usually overpriced. And so IPO stands for it's probably overpriced. Because think about it. Those guys who started a company, they want to sell it at as high a price as possible. So you as the buyer, you're always paying the highest price at IPO. A new company at IPO and hoping it's going to be the next Amazon or the next Facebook, it's kind of like being a princess and kissing a frog and hoping it's going to turn into a prince. All right, so you're going to kiss a lot of frogs before one becomes a prince. In the meantime, you have got smelly mouth, okay? So for me, I rather, if as a princess, instead of, kissing a frog, I rather find one that's already a prince. All right, because if I kiss that prince, it's more certain it's already a prince. Got it? So let me give you an example. So let's look at Uber, for example. A lot of people were drawn in to invest in Uber because, again, it was a lot of hype. Everyone was riding on an Uber, and it was a big mistake because it was a lousy business. Why? Let's take a look at some of the fundamentals. Now, again, Uber listed in the mid of 2019. So you can see that before it IPO'd, it had this great increase in revenue. And they all show that, all showing, hey, you know what, I can sell a lot of products. But revenue was increasing, but again, net profit was negative, right? They were losing money. And before they went IPO, they did show a profit. So people say, hey, they're making money, right? But what did I tell you? Very often before IPOs, companies tend to find a way to inflate their profits by cutting expenses and salaries so it looks good, right? And once they went IPO and people buy the shares, the real expenses come in, right? They increase their salaries and all that, and boom, they lose money, right? And the share price goes down. So that's the problem with that. Look at their net profit. So again, net profit was losing money, losing money. Sorry, over here, right? This is one in blue, right? Losing money, losing a lot of money, making some money before IPO, and after IPO, losing a lot of money again. So very questionable was this inflated. And look at their cash flow. The actual cash coming into the business was negative. So there was more outflow than inflow, which again is common for a new business. I'm not faulting them with that, but I'm here to tell you that with IPOs, it's very risky because they have not yet proven that they can really make money. So you're buying a lot of promise, a lot of hype in that way. Wait, this screenshot is from gurufocus.com. Do check out their website. It's a great resource website. Now, I remember at that time, a lot of students asked me about investing in Uber, and I said to them, in my opinion, Uber is a lousy business because it's in a very, very competitive industry, which is transport. They're competing with cabs, there are other ride-hailing apps. And if you actually read the prospectus, there's no clear indication of how they're ever going to make money consistently, right? If you actually read the prospectus. The trouble is most people, they don't read the prospectus because it's full of financial jargon, okay? But you have to read the prospectus because you have to understand the business you're buying into. And I can tell you that, 9 out of 10 new businesses to me are crap, right? They're lousy companies. In fact, let me share with you an article written by someone who kind of like made it easy to understand the Uber business model. So this guy, his name is Cale Wiseman, right? So what he did was he read the IPO prospectus of Uber, which I read, and he translated the financial jargon into simple plain English, and it's pretty entertaining, but it makes a lot of sense. It's really, really true, right? So here's what he wrote about the abbreviated version of Uber's prospectus, right? We don't make money, okay? We probably will never make money. That's what they were saying in their prospectus in a very financial jargon way. Our current business relies on shareholders to fund cheap cab rides in the hope that regulators will let us become a monopoly and charge whatever we want, but the regulators are not playing along. We have therefore spent more money expanding into other low-margin, highly competitive activities like food delivery or trucking, despite there being lots of specialist logistics firms, so not obvious how we're going to make money there either. We hope in the future there'll be driverless cars and that we can make money because no drivers, but other people are developing them too. We've annoyed lots of regulators, so we have lots of disputes and problems with them. We don't pay much tax. We have done lots of aggressive tax planning, so we have a lot of disputes with tax authorities as well. We don't employ people, or we say we don't, but we have lots of de facto employees, and so we have a lot of disputes and problems with drivers and employment tribunals. We don't actually own many assets because we managed to get our drivers to provide their own cars. We have an app, but other cab companies have apps as well. Current investors want to get out, so we hope you will buy some shares anyway because you have heard of us also. We need more money to fund the businesses that don't make money. We're expanding into more businesses that don't make money, and we need more money to fund those. We are really big, and you have heard of us, plus we say we are tech disruptors, so don't worry that we make no money. It will all be great because you'll be an Uber investor. Right? Yeah, but essentially if you read the prospectus, that's what you come away with. And sure enough, people who didn't bother to do their research, they would have lost money on their IPO investment, and they deserve it, right? Remember, whenever you lose money investing in the stock market, it's because you deserve it. You did not do your homework. You bought into the hype and you got killed, right? So again, IPO was offered at $45. It opened at $42 and it plunged all the way to $13 since recovered. But again, it's going nowhere. So you got to avoid IPOs of lousy businesses by really analyzing the business. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.